Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Last month, as we all know, the Indian regulators, that is the Securities and Exchange Board of India and National Stock Exchange collectively, worked together and caught Jane Street, a very large high-frequency trading firm of the US, for allegedly manipulating the Indian market, Indian derivatives market. Now, this may seem like a regulatory triumph, but in truth, it laid bare the deep structural flaws at the heart of India's derivatives market after years of very fast growth. A lot of people have been talking about these flaws, but not much has actually come out in a very systematic manner. But the SEBI's investigation is fairly detailed, and now we know what was going on. Now, for one, the indices that are used to trade in futures and options are flawed. Secondly, the massive volumes that derivatives market generates is proof, policymakers say, that the F&O markets, the futures and options market, or collectively called derivatives market, this market enables what they say efficient price discovery, improves market liquidity, and allows investors to manage risk. The gigantic volumes in index derivatives are limited to just two indices, Nifty 50 and Bank Nifty, and to a smaller extent in Fin Nifty, but that's very minor. So, actually, does this amount of frothy volumes allow any of these things to happen, which is price discovery, improving liquidity, and allowing investors to manage risk? I don't think so at all, and I'll explain why. But first, let's discuss the indices on which the index options futures are traded. Now, index construction is often seen as a nerdy exercise that involves debating methodological issues such as weights and liquidity, free float, sector representation, and all of that to construct indices, and then reviewing all of that on a periodic basis by adding and deleting stocks from the indices to maintain it. We don't get to know of all that's going on. I mean, there are papers you can download from index construction company, their websites on how it's done. Even NSE's website gives the methodology, but we really don't go into it in deep, except what such technical decisions are not peripheral to trading and speculation, but they have profound implications. Of the two indices that hog almost the entire derivatives market is index futures and options market, that is Bank Nifty. Now, this and Nifty are the two most popular indices. Now, Bank Nifty is extremely skewed. Two of its constituents, HDFC Bank and ICICI Bank, account for a staggering 53% of its weight, just two stocks. The top five stocks in the index together have an 82% weight. Is this an index? Is this a barometer of banking stocks? And can you trade on it? Is that logical? Now, if this index was a product that merely signaled the direction of banking stocks, even though flawed due to faulty weights, it would still be harmless. It would be wrong, but it still would be harmless. But if a mutual fund wants to launch a banking sector fund, they would use Bank Nifty as the benchmark index. This is where the problem starts. SEBI wants investment managers like mutual funds and portfolio management services and alternative investment fund managers. SEBI wants all of them to take benchmark index very seriously. There has to be a logic for choosing a benchmark, and you have to, prove that you've chosen the right benchmark and you're sticking to it. But how meaningful is an index where 53% of the weight is in just two stocks? And if a banking sector fund has investments spread across 25 to 30 stocks, with even say 10% allocated to HDFC Bank and ICICI Bank, how meaningful will be the benchmark index for such a fund? Conversely, should a banking fund put 53% in two stocks that would mirror the index? Now, it gets worse. SEBI allowed the National Stock Exchange to launch Bank Nifty futures, monthly options, and then horrifyingly weekly options on this unsound index. The most liquid banking stock is HDFC Bank. Last Thursday, an expiry day, just around 1900 crore worth of the stock was traded in the cash market, actual HDFC stock. Meanwhile, the traded volume of Bank Nifty call option, only call option, not put, at one strike price, there are different strike prices and different amounts of trading. At one strike price of 57,000, only call option of Bank Nifty trading was 3.98 lakh contracts, worth a notional value of 79,898 crores that day. The smart guys at Jane Street saw this absurdity. In their hands, the harmless Bank Nifty of 12 stocks got weaponized in weekly options. Trading in options was 10 to 12 times the trading in less liquid heavyweights of Bank Nifty. By manipulating a few underlying stocks, mainly HDFC Bank and ICICI Bank, it could swing the entire index and with it, a tsunami of options. Jane Street made the dog, that is HDFC Bank, wag the tail, which is Bank Nifty options. The Bank Nifty is not alone. It's got a financial cousin. We don't know why. The Nifty Financial Services Index, it exhibits the same distortions. HDFC Bank and ICICI Bank account for a combined 54.5% of its weight, even though it's a financial services index which includes insurance. SEBI has permitted derivatives on this index as well, though mercifully weekly options are not allowed there, and hence there are not much volumes, not compared to Bank Nifty. The larger question is whether India's F&O market serves any real purpose. Between FY 2018 and FY 2024, the notional turnover in derivatives skyrocketed from 1,650 lakh crore to nearly 80,000 lakh crore. Now, India accounts for up to half of global exchange traded derivatives volume, with equity index options dominating. These statistics suggest that India has reached the free market utopia of price discovery, liquidity, and hedging. What a fantastic liquid market it is, isn't it? And so easy to hedge. That's an entirely false belief. The bulk of this activity is concentrated in two indices, as I said, Nifty 50 and Bank Nifty. And behind their frothy volumes lies an ugly truth. Even though NSE has launched over a dozen other indices, almost 15 to 20 if you take a total count, most of them lie dormant. What about claims that F&O volumes help to manage risk through hedging? Mutual funds, portfolio management services, and individual investors have 60 to 80% of their portfolios now, currently, after last 4 years of bull market, in small and mid-cap stocks. What will they hedge this portfolio with? Surely not Nifty 50, comprising 50 large companies, or Bank Nifty, which is a sectoral index. Yet, there are no viable options market for indices like the small cap 50 or mid cap 50. Even the Nifty Next 50 is a ghost town in derivatives trading. This proves the fact that what happens inside the frothy F&O market has nothing to do with the cash market. Price discovery is illusory. Liquidity is superficial. Hedging is theory, not a practice. How did it come to this? SEBI has taken a hands-off approach to index construction, allowed skewed benchmarks to be used. It has greenlit the NSE's speculative offerings, and having allowed these products, the regulators have failed to monitor their use cases, which is how they're actually used, which is speculative trading by small-time investors, and then the high-frequency trading guys coming and manipulating. And therefore, the regulators have failed to impose market-wide position limits and intraday monitoring. The speculative zeal in some derivatives has ballooned to unhealthy levels, while other derivatives, which are actually required, which ought to be more useful, like small cap 50 or mid cap, etc., are languishing in illiquidity. Jane Street may have scammed a faulty system, but it not built it, and we know who did. Thanks for watching, and if you do like this, please do share and do subscribe to this channel. Thank you.